The number of companies at risk of defaulting on their debts, going bankrupt, or permanently closing their doors continues to rise as we enter another economic downturn, and consumers cut back on spending on non-essential goods. In fact, earlier this year, the CEO of Toys R Us warned that a wave of bankruptcies would hit the retail sector during 2022's final quarter, due to the compounding effects of inflation, supply chain shortages, and transportation disruptions. We are experiencing the worst supply chain crisis that any of us can recall, and there is no indication that things will get better before the end of the year. For retailers, the problems could be especially bad as they get ready for peak trading in the months leading up to the holiday season and the autumn. In this video, we will talk about 12 retailers that face bankruptcy as deep dark winter coming. But before that, please like, subscribe, and click the bell button for the latest economic updates. Now let's get started. 1. Victoria's Secret. To put it bluntly, the issue with the retailer is far more serious than that, as the company is losing support from even its most devoted customers as a result of controversial statements and social media scandals in recent years. To put it another way, the lingerie giant is currently closing over 1,000 stores across the country. For years, it has been suffering from lackluster sales and slower foot traffic, and it edged near bankruptcy in 2020 during the pandemic shutdowns. Because of its poor reputation today and the emergence of brands that are more comfortable and inclusive, Victoria's Secret's survival is in jeopardy. 2. Bed Bath & Beyond. The retailer has experienced ups and downs over the past 2 years. When lockdowns first started, sales soared, but a few months later, supply chain problems and a sharp decline in consumer spending crushed the business's profits. From that point on, things only got worse for Bed Bath & Beyond. The retail chain is reportedly at great risk of going bankrupt as it starts refinancing its massive $1.7 billion debt load one at a time, according to the Wall Street Journal. During the summer, the company's CEO resigned after a very disappointing quarterly earnings report in August alone. The household brand has already announced plans to close over 150 stores and lay off staff to cut expenses before the end of the year. The company's ability to survive the holiday season is still up in the air as inflationary pressures keep eroding purchasing power. But industry analysts are calling its current situation the year's biggest retail train wreck. 3. Wayfair. The home goods retailer is a presumed favorite, but even the sharpest preference may not be enough to save Wayfair. The company has been posting a net loss for every year it has ever disclosed publicly, going back to 2011. Even when demand for home furnishings went up, Wayfair's revenues were still modest given that it kept operating on a very thin profit margin for the entire year 2021. Wayfair was in the red, but things became noticeably worse this July, when the company was the only one to report its financial results publicly. Global data indicates that, despite having some of the highest revenue in the industry, Wayfair's business model has a fundamental flaw. It requires much higher volumes and a lot more loyal customers to become profitable. 4. Digital brands. The Digital Brands Group, which went public less than a year ago, is expressing concern that a lack of liquidity could cause it to fail by the end of the year. The developer experienced significant losses in 2022. In February, creditors sued it for past due payments. One of them demanded that the retailer postpone its expansion plans until it received payment for goods that had already been shipped in 2019 and 2020. In the second quarter, the company's operating loss was $10.7 million. It also owes $6 million to a secured lender, which is due in December, and creditors are currently on edge because of the high risk of default. 5. Rite Aid. With more than 2,500 locations across 19 states, the renowned U.S. pharmacy chain is in serious trouble. While its pharmacy competitors prospered earlier this year, Rite Aid managed to lose more than $600 million during the pandemic. In the final week of September, after earnings reports were much weaker than anticipated, Deutsche Bank analyst George Hill issued a damning downgrade of the struggling retailer, warning that it could go out of business entirely within a few months. The retailer's stocks fell by 28% in a single day. The fact that the company has a staggering $3.2 billion in debt after years of reckless expansion that hasn't paid off from those puts you in danger of default as maturities approach next month, according to a Wall Street analyst who claimed Rite Aid has lost the ability to generate enough cash to stay afloat, and that its demise is only a matter of time. 6. Tuesday morning. In the most recent quarter, Tuesday mornings reported a 7% drop in sales and projected an adjusted loss of up to $29 million for its current fiscal year, making it one of the numerous retailers that have already declared bankruptcy and are now in danger of going out of business completely. A dramatic revenue decline in 2020 caused the retailer to run out of money and seek protection as its debt increased by $10 million. A holiday season is going to be a make-or-break moment for the already bankrupt retailer, who has closed 200 stores since January 2021. But if projections are accurate, this means the company's near-term future is going to be extremely bleak. Global Market Intelligence was listed Tuesday morning as one of the most vulnerable retail companies right now. 7. Best Buy. Best Buy recently joined the list of retailers warning about slower consumer spending this quarter. It cited weaker electronics demand and ongoing inflation as the primary causes of its most recent financial difficulties. Following the announcement of lower profits, the company's shares initially decreased by more than 10%. Due to its inability to keep up with more powerful rivals, the company is about to enter a dark winter. 8. Toys R Us. The company first declared bankruptcy in 2017 while drowning in $7.9 billion in debt. Since then, Toys R Us has been liquidated, resurrected, liquidated again, and resurrected once more. However, in August, lenders questioned how many more defeats the company could withstand. Operating at an average loss of $1.9 million per month, the retailer has already lost $21.8 million while having a total debt of $5 billion. 9. The Children's Place. Forbes reports that the largest children's apparel retailer in the country continues to experience losses. After publishing its second quarter fiscal report, the company's shares dropped 11% the following day as a result of the company's poor performance. Investors also noted that cautious consumer behavior acknowledges rising inflation, increased promotional activity from key competitors, and sluggish demand. The Children's Place is currently on track to shut down more than 300 locations, and a lot more closures might be announced soon. 10. Capri. A luxury retailer that manages Versace, Michael Kors, Jimmy Choo, and other brands is currently closing 170 locations nationwide, and executives are preparing for a 70% revenue drop this year, so the holidays may not be much to celebrate in Capri. Supply chain issues and shifting consumer preferences, the company's fortunes have turned upside down in the past year due to trends, and its nearly $150 million in distressed debt doesn't help either. 11. Chuck E. Cheese. The beloved restaurant chain's days may be numbered. According to the Wall Street Journal, CEC Entertainment, the company's parent company, recently requested a $200 million loan from Landis to keep the business operating. However, with nearly $1 billion in debt and a 21% decline in sales, creditors are still debating whether the company is worth saving. Executives argue that the restaurant chain isn't keeping up with consumers' behavioral changes, and soon it'll become too boring for today's kids. 12. Brooks Brothers. The most recognizable American brand is Brooks Brothers, according to William Sussman, managing director of Threadstone Advisors. This is an instance of a failed business, not a failed brand. The apparel retailer, known for its suits and formal wear, was particularly hard hit by the health crisis as remote work, job interviews through Zoom, and the cancellation of events like weddings, bar mitzvahs, and graduations led to sharp sales declines, but revenues have been stable since 2016. The company was in need of cash at the height of the pandemic, so it filed for Chapter 11 bankruptcy. So, what's your takeaway from this video? Let us know in the comments section below. If you found this video thrilling, make sure to hit the like button. Also, subscribe to the channel and press the bell icon to never miss an update from us. Thank you for watching. We'll see you at the next one. Until then, peace.